Okay, so number one, what are you doing to protect yourself from a major sell-off in the market today? Our strategy does a lot, but today's trailer was in the treasury market with the TLT ETF. That's the safest way to protect your portfolio. It has very limited downside risk because we've got the Fed purchasing $100 billion a month of treasuries. So they're not going to go too low with $100 billion of money flowing into it. But we also have put options under the SPY. Now, if you just buy put options by itself, those tend to lose a lot of money very rapidly. So we're not a big fan of investing too much money in put options. And instead of actually putting our own money down for put options, we like to sell a call option that's out of the money to finance our downside protection. So how about we take candy from a baby selling call options, which do not take away our potential profit from the upside very much, and then be able to protect against downside risks for nearly free. Couple that with a large bond portfolio and a little gold, and you'll see our strategy has done extremely well during market volatility. Specifically, look at our returns in December and in May, as well as August. Both of those, all three of those months were very volatile in the stock market, and we had some of our best gains. Now, on the other side of the coin, we're not losing money when equities are going up. So it's a good marriage of both. Okay, we got 7 out of 11. Someone new joined, Tom Sharp. Welcome to the webinar. Let me, Tom, we got a poll up if you want to go through it and participate. We'd love to have you in there. How's it going, Tom?
I'm doing well, thank you. Good morning, everybody.
Morning, Tom.
Great to hear from you, Tom.
Pardon me?
Oh, great to have you live with us, Tom, and hear your voice. Thanks for joining.
Thank you.
Okay, so in question 1, what we're going to learn today is the best way to protect the downside risk is to have a stock bond mix. And then on top of that, that gives us a great level of support with just our bonds and our gold position with limited downside risk. But then if we can finance free put options by selling out of the money calls, you'll see that really, really protects your portfolio to what I call atomic bomb proof. That's why we can put these trades on and then not worry about them until the next trading period. Okay, question 2. Did you realize S&P 500 is up 450% since the last crash? So that's a big gain. And what's funny is the amount of money that's actually in the world is about, at least in US dollars, is 1/10 the value of the S&P 500. So you got to ask yourself, can we all get out? If there's 10 times the value in stocks as there are real dollars, does that make you worried? What happens when the billionaires decide it's time to sell?
Yeah, great. Jason.
Not going to be enough dollars to save the day, will there? So if you're all in on stocks, be careful. Okay, number 3, do you have at least $100,000 in cash? And where do you have it invested? Are you in micro cap, small cap, or mid cap stocks? If so, have you lost your mind? Just kidding. But a lot of the folks who actually will literally want us to log into their, with the Zoom and look at over their shoulder, they have these huge positions in tiny companies. You know, if we look at the S&P 500, the largest position is 4.5% in Microsoft. And we go look at your portfolio, you have 4.5% in something like AMD or some biotech company. Absolute insanity. We want to put our money behind monopolies that have extremely low risk. Companies that will be here a decade from now, no question. We don't want to be putting our money behind speculative assets who are busy doing pump and dump schemes to raise cash. Okay, do you have more than 10 positions? If so, do you have 20, 30, 40? Does that drive you crazy trying to look at the screenshots and the charts every day? Our portfolio has 4, but keep in mind with 2 of those ETFs, the SPY and the Emerging Markets ETF, we actually have 1,500 stocks that are automatically balanced for us by pros. So you may feel like you have a diversified portfolio with a bunch of random stocks, but it's not as diversified as our 4 ETF portfolio. And then you look at the TLT, well, that's tax receipts on 350 million people that are pulling the profits out of the S&P 500. And then you look at GDX, that's some 50 gold miners, which has the bulk of the assets in just 2, GOLD and NEM. If you are holding any gold positions and your biggest position is not in NEM or GOLD or GDX, I'd highly suggest you pay close attention to this presentation. Okay, and 5, did you make profits in the 2018 Christmas massacre? We have 2 folks who did well, one who shorted the market, good for you, and one who was properly hedged. The other 5 lost money or were not invested. Now, if you're not invested in the markets, you got to realize this. The central bank has a mandate to create inflation at a rate of 2%. And that's the number they report. But if we go back to 1990 or 1980 and look at how they calculated inflation, we're already sitting on 4 to 6% per year inflation. So if you're not invested, your buying power is going to shrink every year into your retirement. So you really don't have the choice to just sit in cash because everything is rapidly going up in cost. Think about medical, think about housing. So we have to be invested to protect the buying power of our cash. Okay, great guys. Thanks for participating in the poll. Let's take a look at what we got going here. Okay, I'm sharing the results so you guys can take a look at that. That was fun. Thanks for putting that together. Dean, put those questions together.
My pleasure, Jason. That was really cool. We'll have to do more of those.
Yeah, we'll try to have different questions each week. All right, guys, I'm going to do a quick presentation about our strategy, how it works, and then we're going to show you just how easy it is to put on these trades. Make sure everyone really understands what you got to do. And at the end of this, I'd love to get you guys signed up and actually doing the trades. That's what really sells the program, is the results. So daily income trade alerts at noon Eastern. Target return of investment is 1% a month. We've had one losing month of -1% with an average of 1.5%. Here's your setup with the current market conditions where we have a potential trade deal and a period of peace in the trade war. We're slightly overweight in equities, 48%, in stocks, 40% in bonds, 12% in gold. Target income per $75,000 invested is $750 a month. However, we've been averaging more like $1,000 a month per 75K. To follow the program, you would need 100 shares of the SPY. Now, a lot of members, especially yesterday, were complimenting me that the program's so easy, they were able to do it in the line of an airport before boarding. Literally on the way into the airport, he got the trade alert on his phone, punched it in, and he was good to go 30 seconds. What's really important, though, is that these positions will not, under any circumstances, be touched outside of the trading day and time. Okay, if we were sending out random alerts throughout the day, the appeal of this product would be diminished dramatically, because you won't be able to count on having a lifestyle you can enjoy and being able to predict when the trade alerts come out. So that is a huge benefit to this program, is we are not going to touch these positions for any reason under the sun outside of the trading days. The SPY ETF is traded Monday, Wednesday, Friday at noon. You get the email, the text, and then the live stream video. So if you click on that video, not only will I talk about the trade for about an hour, you can type in the live chat and ask me any questions. Are you not sure about something? Post your question, we'll take care of it. Emerging Markets ETF is our Tuesday play. The Tuesday play is how we add an extra edge to our portfolio based on what's going on in the world. So this is rotated from Apple to silver to most recently emerging markets. The potential return I see on the SPY if the phase 1 deal is approved, which should potentially happen November 15th, is 10% run up in the SPY. That would push the SPY to 315 to 330. And that's where I think it would tap out. And again, this is because we have the Fed going into QE, plus we have uncertainty being removed from the markets. Emerging markets has been smashed by the administration by 20%. You study what politicians love to do. They love to smash different industries so their buddies can go in there and buy it up at a discount. Maybe a little early, but we can play with our options both directions. Right now, I'm expecting emerging markets to potentially get back to the 2017 highs. That's a 20% run up from here. That's not to break into new highs like we're expecting the SPY to do. That's just to get back to where it was about 2 years ago. So that's $9,000 to have 200 shares of emerging markets. TLT has generated a profit in 9 out of the last 11 months. So we had a pullback in the TLT over the last 2 weeks, but the big picture for the TLT remains intact until we have a phase 2 trade deal, which I don't think is going to happen. We want to be long the TLT. And if you think all the shit slinging between the politicians is bad right now, wait until we get closer to the election. Can you imagine all the dirty secrets and dirty tricks both parties will be playing on one another? It's going to get messy. We got to have that TLT position. We're happy to have a little drawdown in TLT and GDX right now because we have the Fed lowering rates. We have the Fed printing massive money, bailing out the banks again. All we need is a little fear, and that TLT and GDX will come into play. So here's something to keep in mind. While we're going to trade the SPY, emerging markets, and TLT on these set dates, where we sell a call option out of the money, typically, so we're not going to miss out on most of the upside move. We're going to have a downside protection where we're long a put at all times. That's why these trades are atomic bomb proof. That's why I can, with good faith, tell you, under no circumstances will you have to touch these positions. Oh, hey, Jerry made it. How's it going, Jerry?
Doing great. How are you?
Jerry's been following us since, what, January? February?
Yeah, a long time.
Yeah, and he keeps showing up. I guess we're doing something right. So, okay, guys, so SPY, emerging markets, TLT, we're not going to touch them outside of these dates. That's why this program's so popular. You know when we're trading it, you have a pretty good idea. One of the guys yesterday was joking that his new fun thing to do is try to guess exactly which strikes I'm going to pick before it comes out. But other than that, he's in and out in a couple minutes. Now, the GDX position, we're not going to be protecting. That's 10% of our total portfolio. It's buy and hold. If I really thought there was a potential downside move, we might buy a put, but we're not going to be selling a call option. That portfolio is up 50% in the last 11 months, and it's done it because we're not short changing ourselves by selling call options. My expectation is that the central banks are about to undergo more quantitative easing than ever before in history. So this will be extremely bullish for gold. All right, let's take a look at some real trades, how to put the trades on. Here is a recent trade alert from Wednesday. And here's your typical trade alert, guys. Every day it's almost identical. Again, the only thing that really changes is the asset we're trading. Monday, Wednesday, Friday, it's the SPY. Tuesday, currently emerging markets. If the trade deal breaks down, it may rotate into silver. Thursday is a TLT. These are not going to change. These assets are the best assets you can possibly own in terms of quality, safety, and a marriage that works together so that when one goes down, the other protects. So the first thing you'll see in every trade alert is a summary of the results. Here's what we need to track. When we put on the trade, what was the price of the underlying asset? In this case, this is the trade that we closed out on Wednesday. So it's looking at the trade from Monday through Wednesday in this alert. So from Monday through Wednesday, the SPY ETF traveled from 296.33 to 298.73 for a return of $2.40. Now on Monday, even though Trump had gone on national TV with one of the representatives from China after the market closed and said, hey, we got a deal, this is great. China was not saying the same thing come Monday. In fact, they said, we'll see about it. We didn't say anything that Trump said. We got to talk to our people. So it wasn't really very surefire on Monday. And as we'll look at today's update, you'll see it's still not very surefire, despite what Kudlow and all of our trade representatives would lead us to believe. Now, the Chinese are saying a little more positive commentary, which is why we did a more bullish trade on Wednesday, which we'll look at as well in this trade alert. So we had a tight option collar, which we collected 60 cents from. To exit that collar, we had to pay $1.79. So we lost $1.19 of that $2.40 move. That's okay. We had a lot of protection. We could lose very little on the SPY, and we still walked away with $1.21 a share with approximately 30% of our total portfolio. So that's your summary. You'll want to do this audit yourself, even though we're going to have very, very close results. Why trust me when you can easily audit your returns with just two numbers? What did the asset do? What did the options do? Okay, next I'm going to give you the key news summarized. Now the video will go over this in more detail, but if you just want to read, I'm going to tell you what are the most critical things that you need to be paying attention to that are going to dramatically alter the potential moves in the markets. Okay, after that, we're going to give you our total return for each portfolio broken down. Some people want to just follow one portfolio or the other. So that's why we have it split up like this. It gives you the power to have that control. My recommendation is just do the whole system to get the best results. Some folks just like to trade the SPY. Some folks are just doing the Tuesday, Thursday. Some folks have very little capital and really want to make a lot of money are just following our precious metals portfolio, which is up 53%. Then what we do is we'll break down the return month by month for you so you can check that out. You get a link to the track record. And then we jump into the new trade. So the first step is going to be to close out the previous trade. Now, if you didn't take the previous trade, you can skip step one. In this case, our put option had gone to 1 cent. No one's going to pay 1 cent for a worthless put option, so we let it expire worthless. On the other hand, we do always have to close out our short call position, the covered call. So we had to buy to close the October 16th, 297 call. That's how we got out of that trade. That's that $1.79 debit. So you can see this figure right here will always match this figure right here. And because I'm doing the trade about 30 minutes before it makes it to your inbox, we're going to get very, very close results. Step two, sell to open the 301 call. And what we're going to do right now is calculate how much money we've made on this trade together and how to close it out. So step two, for every 100 shares of the SPY you own, enter one of the following option contracts. Okay, so let's look at a few important things. The last trading price when I entered this trade is $298.73. I'm selling the 301 call option. All that means is I agree to sell my shares of the SPY for $301 if the option buyer chooses to exercise his right. And if he does, I also get to keep his option premium he paid for that right. In this case, 29 cents. So you can do the math. The SPY's going to go to 301.29 before this fellow's making any money. Because think about it. Why is he going to pay 301 a share if it's only worth 298? He's not. Plus, he has to also let me keep the option premium. So this fellow is looking for a home run hit. It's not going to happen very often. And even if it does, we walk away with a great profit. So it's perfectly fine in our point of view if the SPY goes to 310 and the guy makes a fortune. Good for him. We still made a great profit, and we had downside protection, primarily financed by this option buyer. So we're selling call options and buying put options. Who's selling us the put? Who's willing to pay $2.96 a share for our SPY shares, no matter how low they go? That's Wall Street. That is huge. Banks, they are selling out of the money puts on every security under the sun, and they're making a fortune doing it. And they don't mind picking up some SPY shares if they're down $2, $3, $4, $5, because they're making so much money selling these put options, and they have access to almost unlimited capital. It's a great business. From our point of view, it's a great deal. We have great upside potential, but if something really terrible happened and equities crash $5, $10, $20, doesn't matter. We get $2.96 a share. So it's a wonderful setup for us. The next thing you're going to get is a risk graph. This shows you your potential outcomes. In this setup, we had the potential to lose $2.87 a share max, and the maximum profit of $2.13. So let's just look at how we'd close out this trade today. Now, every broker dealer looks a little different, but at the end of the day, they're all the same. Okay, so here was our trade. Now in your broker, you're going to actually probably be able to just right-click the trade and close it out. You won't even have to fill out the second order, but I'll just show you how easy it is. This is literally all it takes to do our trades each day. Okay, so let's take a look at the math. Let me get out my little calculator. So from the option standpoint, we paid a debit of 12 cents for our options. And to get out right now, we paid another 7 cents. So we would be losing 19 cents on our protection. But how much did we make on the SPY in this trade? Well, last trading price is $299.36. So right now, as of this moment, if we were to close out the trade, we're up 63 cents, minus 7 cents, and then minus 12 cents. So we're up 44 cents a share. That's $44 a contract. Now, what if we make $44 3 times a week, 52 weeks a year? That's $6,864 of income just from this tiny profit being created 3 times a week. That's the power of taking advantage of the options 3 times a week on the SPY. So then what would we do next? Go to the next expiration. Sell to open, buy to open. Probably move this up to 302, and voila, you got your next trade. Now, Elizabeth, I know you were one of the folks last week who really wanted to join the program, but you were concerned that you may not be able to follow the trades. Let me ask you this. after seeing that demonstration, what questions still remain in your head about how to follow the trades? And you can use your mic or your chat box to reply to that. And also, for anyone else still on the webinar, please let me know if you have any questions at this point.
Yeah, and Elizabeth, let us know too if you have been able to replicate one of our trades with your broker as well. I know that was something you were working on in the paper trading side.
Let's see, any other questions out there before I move along? Let's see, we got Joseph. I just unmuted your mic in case you have any questions. All right, well, that shows you just how easy it is to get in and out of the trade. And again, to close it, we would buy to close, sell to close. And then we go to the next expiration and do it all over again. So that just shows you how simple this is. And it's the exact same setup on each of our assets. All right, guys, what I'd like to do now is take a look at today's trade alert and some of the most important news that's going to affect how we play the markets. And again, if anyone has any questions out there, please let me know.
Yep, the more questions you all have for us, the better off we're going to be helping you out and definitely understanding, what we need to work on too to possibly improve the product. So please feel free to ask questions. And Jason, just real quick, one thing I wanted to touch on too, folks. So one of the things that a lot of our clients have done is they'll actually replicate trades with their paper trading account within their brokerage for a week or two, and then start using real capital. Some of the people that we've had that are actually using the most capital now behind the system, that's exactly what they did. And then they'd scale into 100,000 and then go to 200,000 and then go to 500,000, then go to literally millions. So that's a phenomenal way to kind of get comfortable and used to it too. But as you see, it's literally 4 to 5 clicks in your brokerage account. It's super easy.
And I did see Elizabeth says she has a technical difficulty. I'm glad to see you chatting there. Do you want to try to unmute your microphone, Elizabeth? Or what do you think? Do you understand how to do the trades now? A lot of people are blown away by how simple we've made this because they're used to doing, naked puts, calendar spreads, iron condors, bull call spreads, it just goes on and on. Vertical spreads, it's just, we don't need to be a rocket scientist to play the markets in a smart and intelligent manner. All right, well, let me take a look at some of our forecasts of how I predict the markets will be moving. What are the big things to focus on? And so over the last few months, okay, great, Elizabeth. And also I do want to point out, we do have an option to join where you get both the boot camp and the advisory, where it's like tennis practice. It's not, you can go watch some, how-to videos out there. You could go watch a tennis player serve a ball, but that doesn't necessarily mean you'll be able to go on the court and serve the ball. What you really need is someone to kind of sit there and coach you. So that is another option to consider. All right, let me take a look at what I see coming out. Now, over the last few months, the main thing I wanted everyone to focus on was if the Chinese would buy agricultural products. If so, I thought that'd be enough to get some sort of short-term victory in the trade deal where we would delay the December 15th tariffs and they would buy a whole bunch of farming goods. And sure enough, it happened. So this is a very bullish catalyst. And at the same time, we have the central banks lowering interest rates and starting up QE. So those are the two most bullish things we could have possibly had to be long equities. But of course, it's never just that safe to go 100% on equities. Otherwise, everybody would be getting rich from the stock market, right? So let's take a look at what's been transpiring since that has really been playing out in the last few weeks. So this morning we have Larry Kudlow, Steve Mnuchin, all telling us trade deal looks great. We may not have IP theft in this one, but everything's looking great. Chinese Commerce Ministry is putting out tweets about wanting all tariffs dropped, not just delaying the December 15th tariffs, and also wanting to block a Hong Kong bill being pushed through US legislature. So that's not really matching up now, is it? So that's a big question. The Chinese are also having food inflation, very bad food inflation, which is a big problem. When you have a tiny group of people who tax their citizens at a 70% rate, censors their speech, you better keep them fed with the house over their head, or they're going to get pissed. So I think the Chinese are very motivated to purchase agricultural products, and they just cannot get enough food from Brazil and all these other countries who don't have the infrastructure and legal system that the US does to be able to produce massive amounts of food. So I was suspecting that this would not make the Communist Party look bad if they were to purchase food products. In fact, people would probably celebrate it. And in the same note, Trump would not look bad with his base if he can save the farmers, key folks for his November election. So that made sense. Now, as far as getting the Chinese to stop subsidizing key industries, stealing technology, growing their military, trying to expand into the Southern Sea, creating massive naval forces 4 times the speed of the US, that's not going to stop. If you think that's going to stop, just go look at President Xi's speech at the start of the year, where he clearly outlines what his goals are for China. And it's clearly to become the #1 superpower in the world. So this trade war is having a little breather. If you go back to the Cold War, that puppy lasted 3 decades. There's periods of truce, there's periods of escalation. Right now, I'm just expecting a small period of truce. So if this happens, my expectation is 10% move on the SPY in our favor, 20% move in emerging markets in our favor. But will Trump tarnish his reputation and really drop all of the tariffs? And will the Chinese really demand that? That's a big question. Meanwhile, China cannot lose control of Hong Kong. That is their only point to receive capital from the world. They've grown their money supply by 1,000% in 10 years. That's a 50% increase per year. Okay, America's growing their debt at a much slower rate, closer to GDP, maybe 1 point above GDP. They're growing their debt 40 points above their GDP, and their GDP is crashing. So China is in some serious, serious trouble without outside capital and without expanding all these ridiculous projects. If you go to YouTube and start to search, don't look at finance. I like to look at people who just like to go to China and explore it for whatever bizarre reason. They blog about it. And there's this guy who's going on his bike through all these ghost cities. And there are these giant mansions all over the place, completely empty. And that's because to keep these GDP numbers strong, to keep outside capital flowing into China, their strategy has been to build ghost city after ghost city. They have 50 ghost cities that are nearly the size of New York City. Skyscrapers, houses, mansions, completely unoccupied. Even in their tier 1 cities, in these massive skyscrapers they've built, they're not occupied. Even in Shanghai, they're not occupied. So it's a house of cards. The only way they keep it up is they continue to build, build, build. They're great builders, but they're building stuff that no one's using. Did anybody see their new airport they just built? It looks like it's from Star Trek. They're 100 years early. So losing control of Hong Kong would be detrimental to China. And who knows, is the CIA, the US behind this massive protest? Maybe. Perhaps it's a playing card in the trade war. But the problems in Hong Kong are not going away. So to just go all out long equities right now would be a mistake. There's plenty of risks to be afraid of and things that could go wrong. Furthermore, is it in China's best interest to create any deal of any kind before the November election? How many times have the Chinese told us we're going to do a deal and then they don't do it? So people seem to have a very short memory when it comes to the history of the Chinese. Okay, so that's what's going on with that. We want to be overweight in equities because I think the phase one deal could potentially play out. Phase two, no way. So we have a period of truce. This could be very bullish for equities. Not only do we have the central banks on our side, we have good motivation for these two to at least have a small win for each of their countries. But if something breaks down, the TLT and gold will come into play, should deliver very handsome profits when the next unexpected pullback happens. And don't forget, we have those put options under the SPY that provide the absolute protection. And I do want to point out, if you look at our track record, we've done exceptionally well during periods of turmoil. So December, stocks were crashing at a record pace. We made 1.2%. Now, who would have thought the plunge protection team would come in and jack stocks right back up in January? Why wouldn't it turn into another 08 crisis? Well, we didn't get creamed. We got 2.2%. I developed this program, Jim, but I'm not going to take claim for the strategy. This is Ray Dalio's strategy.
Okay.
Who manages the biggest hedge fund in the world.
Yeah.
So this is a very simple strategy that we've boiled down for investors who unfortunately get carried away following very, very risky systems out there. And so
Okay.
my history was in the last 10 years representing all these so-called gurus out there selling advisory programs. And they were absolutely over aggressive, over risky, and nobody got the results. Even if they were claiming to make money, nobody else was. You join any of my webinars, you'll find everyone, whether we're winning or losing, is getting the same result. And we're also not one of those advisories that tries to, sweep the dirt under the carpet. Let's throw the dirty laundry under the bed. No, we don't do any of that.
Okay.
Okay. So I also want to point out in May, 5% sell-off in the S&P 500. Who knows why? It was just a sell-off because the market had rallied so quickly. We made 2.2%. August, tariffs suddenly come in after we thought we had a deal. July, they told us we got a deal. The G20 meeting in Osaka was great. We're going to have a trade deal, folks. Well, I wasn't expecting that. I was expecting tariffs. We lost 1% in July because of that. So I was wrong. We lost 1%. That's the only month we've lost money. But I tell my folks, I would rather be precautious and wrong than hopeful and right. And the facts are just this. The Chinese do not want to make a trade deal because they're going to give up their competitive advantage in the world with the demands we've been pressing on them. So the tariffs hit in August. We have another freak out in the stocks. We made 1.8%. September was a little slow, 0.3%. October's been wild. So October, let's talk about our results in October. In the first week, our return jumped to 1.1%. It was the best week we'd ever had in profitability, the first week of October. And that was due to stocks selling off. TLT was flying higher. And then Friday came. I had us positioned, not to get creamed if we were wrong, but if the trade deal had broken down, if Trump had come out instead of saying everything's great, we're going to make a deal, and he instead had said, oh, these Chinese are not willing to budge a bit. Tariffs are on for December. Plus, we're going to lay out sanctions on Huawei. We're going to lay out sanctions on, they've got a big list of people they want to lay sanctions on. Things could have been nasty. Equity holders could have been down 3, 5, 10% in October. And we would have been up significantly because of our heavy bond and TLT position. Okay, so we were wrong. Trump came out and said, all right, we're going to do a trade deal. Our portfolio had a maximum drawdown this month of negative 0.5%. So when we're completely wrong, usually because we're protecting against tariff risks, we're able to minimize any sort of drawdown to be very small. And now that we know what the current narrative is between China and the US, now that there is not this huge uncertainty, this guessing game, we can play the facts. We've been playing the facts and racking up profits again all week. So currently we're down 0.3% in October, and I suspect that will turn positive and hopefully hit our 1% target from primarily the SPY and EEM ETF. Now, what I'm also providing in this update, and I think I'll actually do it in each update, is I'm breaking down each portfolio and giving commentary on it. So here's our bond portfolio's return separated from the total return. So again, this screenshot's your total return if you were overlapping the strategies. How's the bond portfolio performed? Wow, it's done very well. It's had 2 losing months in the last 11. So funny enough, when Powell pivoted from being a hawk to stopping the autopilot rate hikes and the quantitative tightening, which he promised us was not going to happen in December, what was our only losing month. So when the Fed became dovish, the bond market was way ahead of the Fed.
So much better than CNBC.
Yeah. Yeah, well, CNBC obviously makes all their money from stock promotions. So they're always going to be your cheerleader for the equities portfolio and never for the gold or bond portfolio. So yeah, look at our portfolio on the TLT. We've had 2 losing months, and I don't think the gravy train is over for the TLT. We have PMIs around the world below 50. We have global growth slowing. We have the IMF predicting the current tariffs will drop GDP worldwide by 80 basis points. And we have a huge country that's ready to go bankrupt with any amount of pressure or capital restrictions, and that's China. So think about the 2008 crash. We had the housing market where we had a lot of malinvestment in the US. Go back to the dot-com bubble. Sure, we had a couple trillion malinvested in crazy startups like pets.com and all kinds of crap. All right, now let's look at today. How much money has China malinvested? It's more like $20 trillion. When they go up, it is going to be insane. And so we're at a very pivotal point in time here where the US could certainly put the pressure on China and create a global recession, maybe even a global depression. But does Trump want to do this before his election? I don't think so. Moving down, let's look at our SPY. It may be time for the SPY to shine, potentially all the way through the election. Depends on how aggressive Trump gets with this phase 1, phase 2 deal, and if the Chinese are reasonable or not. Now, they may force his hand on this, or they may decide to have a period of peace. And so we have to carefully watch this relationship. But we had a little bit of a slow summer and fall on the SPY. We lost 1.2 in May, we lost 1.1 in July, we lost 1.1 in September. Overall, those were profitable periods because of the bonds. But I believe most likely we have a period of peace and we have the central banks freeing up cash in the banks. They're going to buy equities until the scare. So I really like the SPY for the foreseeable future, at least for the rest of the year. And I think that will deliver the bulk of our profits. But keep in mind, that doesn't mean you don't want to own the TLT. The uncertainties, the unpredictability That's where the TLT really delivers its job in the current market environment. Tuesday trade only represents 10% of our portfolio. Right now, we have the exact same allocation as Stanley Druckenmiller to emerging markets. Does everybody know who that guy is? He's a hedge fund legend. He's averaged 30% a year for 30 years. He's absolutely gold. And there's a whole crew of people who follow his trades. I was not playing emerging markets all year until this breakthrough in the trade deal. He has about 10% of his portfolio, if you check out his latest 13F filings, in emerging markets. So again, just to get back to the 2017 high, there's a 20% move on emerging markets. Now we're going to miss out on some of that because we're playing it very safe. We're selling that call, buying the put. We know how risky China is right now. The only hope it has is to expand its debt even more. So they ran out of fake cities to build. They've got so many empty trains going to London with nobody in them. They had to come up with something new. Their new project's the Belt and Road Initiative, which is a $12 trillion project that's losing funding as we speak all around. It goes through 155 countries. So they've got folks living in poverty with no plumbing all over China with these signs, these billboards saying President Xi is great and we're going to build the Belt and Road Initiative. Yet they don't even have plumbing in these tier 2, tier 3, tier 4 cities. Precious metals has been very rewarding to us, as well as crypto. In December, it was just a 2.5% position in Bitcoin, Ethereum, Bitcoin Cash, Litecoin. And again, this is when prices in those assets had been crashed by 90% and stocks were falling. So we bought a tiny position in that, had remarkable returns. And as the Fed switched gears from being hawkish with monetary policy to being dovish, we have gradually went from a 2.5 to a 5%, all the way up to a 10% position in precious metals. That's a huge position. I don't anticipate increasing that. And we have all the magic ingredients for gold, silver, and Bitcoin to do well in the next year. We have lowering rates in 80% of all central banks. We have quantitative easing in the big three, so Europe, China, America, all printing. The last ingredient is simply a little fear.
Yes.
And so that is our strategy, folks. It's as simple as that. What questions do you have out there? Jim, you have any questions?
Is there a way to get a, can you hear me?
Yes, sir.
Okay. Is there a way to get a copy of this presentation?
Yes, we deliver the copy of the presentation every Saturday.
Okay. Okay. Yeah, because I'd like to look over it a little bit.
Sure, absolutely. Any questions that jump off the top of your head?
No, not right now. I just need to kind of study it.
Jason, this is Jerry. I was wondering, why do you think it would tarnish Trump's reputation?
If he dropped all tariffs, I think that would tarnish. I think you get a lot of backlash from all the pro-military hawks, and also the Democrats would hang him up. He was weak on China. Now, all the pro-China folks will love it. So if he drops all tariffs, equities can go even further than I'm projecting here, I would predict. So my thought, and I've been saying this for months, I thought China is motivated to buy agricultural products because they just cannot buy food at the quantity they need from all these developing countries. They don't have the infrastructure to pull it off. And you've seen that in their price inflation in food. It's skyrocketing. So that's their number one concern, is losing the support of their little slave camp of 1 billion people. And then funny enough, the same thing for Trump is he wants to keep his farmers voting for him in November. So it's a win-win for both parties there. Let's
Well,
see,
thanks.
Dean, is your, I think, see your hands raised, Dean. Jerry, go ahead.
No, I just said thank you. Thanks for that explanation.
Oh, sure. My pleasure. Joe says, love the macro analysis. You guys beat CNBC. That's funny. Oh, I listened to CNBC for most of the day, Joe. So just got to know your bias in every news source. So I'm looking at, I have to grind my teeth or bite my tongue when I turn on CNN, but I listen to CNN, I listen to Fox Business, I listen to CNBC. As far as my live streams, got maybe half a dozen YouTube channels I like to listen to. Got my perma bears I listen to. I've got Russian media source I like to listen to. Sometimes I'll turn on the Chinese media, but it's pretty bad. So as long as you can have a pretty general acceptance from as many points of view as possible, and then play it safe with the allocations we're teaching here. Let me pull that up. I think you're going to have very good results. Let's see, we had someone just join in. Mr. Mason, a little late, but welcome. And you will get a replay sent to you on Saturday of today's webinar. We try to only mail once a day to keep our open rates as high as possible. So that's the only reason why the webinar is delayed till Saturday. So just a heads up for everybody on that. Oh, Elizabeth, did you get your mic to work? Oh, not yet. Let's see, Joseph, Elizabeth, any questions? Oh, Dean's back. You have any final message for our audience, Dean?
Just keep it real brief, Jason. And team, I really think what I've learned from Jason in my experience and following the system is being defensive will allow you to sleep at night like a baby. Okay. Previously in my life, I've done a lot of very, very offensive trading. I was looking at a risk scale of 1 to 10. I was probably an 11 yeah, throughout my life. And, I went through some big periods of losses. And, I built up my accounts quite a bit at this point. And it's so nice to sleep like a baby. And I do have, pretty large sums of capital behind this at this point. And, I'm not, as far as it goes with this strategy, I'm not waking up at, 3 o'clock in the morning to see what the futures are doing because I have a massive call option in Apple that expires in 3 days, right? It just, I've completely gotten out of all microcap stocks at this point, with Jason's help, really.
Well, you're turning 70, right, Dean?
Yeah, exactly. I think, on a risk tolerance, I think I'm about 70 years old at this point. But no, it's just, it's all about capital preservation for me and slow growth. And, once your nest egg's over a certain size, that just makes so much sense. And it's just shocking to me how many people we talk to, that are 65 plus, that are dependent on Social Security or a pension or something, that are just absolutely gambling with their nest egg. And those are the people we're really helping out. And heck, I'm 34. And, I have the majority of my capital behind a really ultra conservative system. And it's just, it's different. My stress levels have gone way down. And yeah, as soon as I have enough capital, I mean, this is all I'll use forever. So that's kind of my 2 cents.
So do you stay out of the casinos?
Yep. I'm not a gambler. Been there, done that.
I've got a bonus roulette system for everybody. Just kidding.
Any other questions from the crowd here, folks? Another thing too, some of our clients have wanted to kind of really understand exactly what Jason's doing at a granular level. And so they've taken the boot camp, which Jason has up on the screen. And so I think that's kind of an important differentiation and distinction too. So if you just want to make the the income and increase your capital and preserve your wealth as you do it, okay, as conservatively and defensively as possible, that's what the service will do for you, okay? Now, if you want to, go down to a granular level like, a lot of our clients have and join the boot camp and, really kind of just go A to Z, understand exactly what Jason's doing and why, follow all of the news, outlets that Jason and I do in different social media and different YouTube channels and such. And really be able to apply kind of a defensive strategy outside of just the markets alone, but other things in life and other positions and other equity markets. That's the boot camp's a great option for that as well. And if you want to do both, we have quite a few clients doing that. But if you want to just sit back and make the money, the service is going to be your best option. If you want to enjoy your retirement and fish or go hiking or whatever it is you enjoy to do, volunteer at your kids your grandkids school or your kids school, hey, I understand. It'll only take you a couple minutes to replicate, but at the same time, if you want to get down to a granular level, really get on Jason's level and just understand how to follow this really incredibly strategically and defensively, the boot camp's a great option for you. Or you can combine both. It's up to you. So.
All right, guys, thank you so much for your time. If you want to get started and get going, call Dean 505-322-7515. And I'll just put up our disclaimer here to close out the webinar. This replay will be sent out Saturday, so keep a lookout for that if you want to rewatch it. Tomorrow we'll be closing out our SPY trade and then putting on a new SPY trade to cover us through the weekend. And then the SPY once again on Monday. So we'll see what comes out of the administration on the China trade war until then. And I hope you guys can join us live for our live stream tomorrow. So thanks again.
Yep. Thank you, folks. And if you have any additional questions, just reach out to me. Happy to answer any question you may have. Okay. 505-322-7515.
Thanks, Jason.
Thanks, guys.
Thanks, Jerry. Have a great day.